Okay. Good morning, friends. Good morning, Kiran. Good morning, Komal. Good morning, Sushil. Diksha, good morning. Good morning, Bhumika, Manish. Great to see you all this morning. Well, today we are going to start with another element of salaries, and that is perquisite. See what we had done until now. We learned the definition of salary. We saw the retirement benefit. We saw allowances. And now we move on to the perquisites. Perquisites, are another important component of salaries. And, probably the one very difficult from the taxation point of view, not from the examination point of view, but then, taxing perquisites at times could be challenging for the department. From the department's perspective, it is a little challenging. Okay, well, I've got a few queries as well. So Bhumika is asking, could you please explain commuted pension? Well, Bhumika will take up problems on salary tomorrow. I mean, in the next lecture, and then that time, we could discuss commuted pension again. But as of now, let's focus on perquisites. Today, my agenda is to cover a lot of perquisites so that, tomorrow we are left with one relief under Section 89, a few practical aspects of salary, and what we could do is a bit of problem solving. So that is what I've reserved my next lecture for. What today, you all would have heard about something called as perks of employment. Colloquially, a lot of employees would tell you that we get a lot of perks. Now, those perks are nothing but perquisites. Perquisites are benefit or amenities, received by an employee over and above his salary. So any benefit or amenity that is in kind, it could be in cash as well, but then usually in kind received by an employee over and above his salary would be perquisite. We have seen something like this earlier when we discussed profit in lieu of salary, wherein what was the exact nature of payment? It was, reimbursement given by the employer to the employee, allowances given by the employer to the employee. Here, it is amenities provided by employer to employee. And therefore, it becomes challenging. Most of the times, these perks are in kind. Now you've got to value the perquisites. There is no set amount. So, like employer paying 10,000 rupees to employee, you know the value of it. 10,000 rupees have been paid. We got to include 10,000 rupees as salary. But what happens when, an employer renders some benefit? He gives a house free of rent to the employee. Now, when that happens, I got to value the rent-free accommodation. Now, this is a real challenge because the value of that rent-free accommodation becomes subjective. It would be subjective. And once it becomes subjective, friends, there could be so much of litigation around because the income tax officer would be inclined to increase the value and he would say, no, this rent-free accommodation is worth rupees, let's say annually, 3 lakh rupees. And the employee would say, no, it is not more than 30,000. This subjectivity has to be reduced, and therefore, there are different rules made for valuation of the perquisite. Now, perks are, perquisites provided by employer to employee are actually wide ranging. You've got perquisite in the nature of car that is provided by the employer to the employee. Accommodation is what I've already talked of. Food is provided sometimes education is provided to the children of the employee. So it's all wide ranging. So even the family members can get benefit on behalf of the on behalf of the employee. So it is not always an employee who is the beneficiary of these perks, but it is also the family members. So children, spouse, dependent parents, brother, sister, or even a dependent servant, that he could receive perks from the employer, and it would form part of the salary of the employee. Why, we'll discuss in a short while, but then understand perks are wide ranging, and therefore, when you look at the definition of perquisite under section 17(2), it says perquisite includes. So it is an inclusive definition that we have got. It says perquisite includes. So you don't have a definitive meaning. It includes this, and it could include anything like this. So that would be perquisite. Now, one very essential thing about perquisite is that, it is not voluntary. It is not voluntary. It is something contractual in nature. Like when the employee is joining the employment, he would want the employer to provide for a rent-free accommodation. Now, the condition of that employment itself requires the employer to provide rent-free accommodation. So it is not voluntary on part of the employer. If it is voluntary, then it might not be perk. Like, say, for instance, there is an employer who is duty bound to take accidental insurance of the employee, because it is a place of hazard and there could be an accident, probable accident could happen. Let's say it is a furnace, and usually such factories do have risk associated, and therefore the employer, to meet contingency, takes an accidental insurance for all its employee. Now, although it is taken, the accidental policy is taken for the benefit of the employee. Benefit flows from that insurance policy to the employee only. However, still it is not, contractual. It is voluntarily done by the employer to mitigate his risk. So whatever is done to mitigate his risk might not be, a perquisite. Perquisite is contractual. That is what I'm trying to emphasize. And therefore, logically, also the valuation of perquisite should be based on the value derived by the employee and not the cost that is incurred by the employer. Employer might incur any amount of cost. However, if the value of that particular benefit advantage is less for the employee, he should be taxed on a lesser amount. So it is the value of benefit that is derived by the employee which is important. And that's why we've got all the rules, and that's why we have to really read them and again and again a couple of times to understand those, because see, there is no set logic. It is only derived out of customs, and gradually it has evolved over time. So you have to read it a couple of times. There is a rationale to it, but it's not entirely logical. Now we'll start with rent-free accommodation. First and the foremost, let's start with rent-free accommodation. This is one of the most common perquisite that is given by the employer to the employee. Most of the times you will find government employees, they have their own quarters. It is something well known that government employees would have their own quarters. They would get a residence. Even the private sector employees also sometimes get residence. Bank employees, bank managers, they do get a rent-free accommodation. Especially in bigger towns, it is not easy to find accommodation, and therefore the employer would give to the employee rent-free accommodation. He'll arrange the accommodation and give it to him. Now, the value of such rent-free accommodation that is provided to the employee would form part of his salary in form of perquisite. So it is the value of the rent-free accommodation. See, we don't talk of the amount, we are talking of the value. This value got to be determined. How this value got to be determined, we'll have to go to explanation 1. And sometimes what happens, you don't give entirely a rent-free accommodation. Sometimes you charge the employee some amount. If you're charging some amount to the employee, the total value would be computed, and out of that, the amount that is charged to the employee would be deducted. So only the balance would be the perquisite in the hands of the employee. See, I'll just show you a picture and you tell me, we've got 3 buildings. You think you are an employee, and the employer is willing to give you any of the buildings that you desire. So it could be A, B, or C. Any of the buildings that you desire, he could give it to you for the purposes of your accommodation. What are you going to choose? You tell me, what are you going to choose if the employer is willing and ready to give you, any of the 3, A, B, or C? Which building are you going to choose? Whether it's the A, B, or the C? Okay, some of you say it's B, Ishan says it's B, Sonali says it's C that I'm going to choose. Well, now if I tell you that boss, C is a hotel, B is a bungalow that is located in, Mumbai, or let's say any other town, and A is a small house located in the suburban areas, far off from Mumbai, let's say 20 kilometers from Mumbai, right? The employee is working in Mumbai, he has got an option. He could go for a hotel, a bungalow, or something far off, a small house. And none of you have chosen A. Why none of you have chosen A is because, it looks small. On the contrary, B is a bigger house and C is a hotel, right? So hotel accommodation is something you would want because there are a lot of other facilities in a hotel. So like you would get a good accommodation, you'll get furniture along with it, you'll have helpers, you'll have the lift man, you have all the facilities in a hotel. So which is more valuable if you consider all 3 of them? The most valuable would be a hotel because hotel would have all the facilities. It is not just a house, it is not just a house, but it has got incidental facilities. You've got a restaurant, you've got a swimming pool, you've got a beautiful furniture, bathroom. So everything is in place. And therefore, when I give you when I narrate to you, well, you would think that hotel is one of the most precious accommodation, maybe 2,000 rupees per day of a tariff, and therefore I would go with a probable hotel because it is more valuable. And that is how, the valuations are done. So if you choose a hotel, you end up paying more because it is more valuable. Similarly, if you choose a bungalow, right, a big bungalow in Mumbai, you end up paying more, than a bungalow which is located in a remote area or a small locality, right? Getting this, friend? So this is the entire basis. So fairly logical, but then, when it comes down to the quantification of it, well, I cannot really provide a lot of logic to it. Why 15%? Why 10%? Let's discuss it, and then we'll understand the rationale. But then there are a few things where there is no logic also. With this, see, the accommodation can be of 3 types. You have a 3 distinct categories of accommodation. The accommodation provided by the employer to the employee could be an unfurnished accommodation. So it is mere accommodation that is provided. 2, it is furnished accommodation. Let's say if the accommodation is furnished. So you've got unfurnished accommodation plus the furniture. And 3, you've got hotel accommodation. So hotel accommodation is completely different. You cannot compare it with either the unfurnished or the furnished accommodation because there is a service element involved. Now, when it is unfurnished accommodation, there could be two parts to the story. One is the employer himself has got the ownership of that particular accommodation, right? Or the the owner, the employer can actually lease it from somebody else and give it to the employee. Both scenarios are very common. Either the the accommodation is owned by the employer himself or he would lease it. Now, if it is owned by the employer himself, the employer doesn't pay any rent for that particular accommodation. He'll give it to the employee. He has got it in, got the accommodation in his ownership. He is not required to pay any rent. However, if he is paying rent to somebody, the valuation becomes very simple. There's an employer who takes a particular house on rent for rupees 10,000 and gives it to the employee. Now, what is the benefit in the hands of the employee? Well, it is the rent which the employer has paid to the landlord. The valuation becomes very simple and it is the actual rent payable by the employer. So whatever the employer pays would become the value. In respect of leased accommodation, it becomes very simple. However, imagine this situation. There is a particular area. Let's say we talk of Mumbai. Mumbai has got a lot of areas where you have got a sea-facing location. And there is an employee who draws salary of rupees, let's say 10 lakhs per annum. He draws 10 lakh rupees per annum of salary. And now he is employed with, let's say, Tata Group. Now, Tata Group has got a lot of properties which is sea facing, and therefore, Tata Groups want to accommodate this employee in one of the flats. They take it on rent from somebody else and they accommodate him in that flat which is sea facing. Now, the rent that they pay is 1 lakh rupees per month. It could happen, there could be, a business exigency that this particular employee is needed at any given point in time throughout the day. And therefore, his residence should be close to the office. Now, if Tata Group pays 1 lakh rupees per month, the value that is derived by the employee isn't 1 lakh. He doesn't want to stay there. His salary is only 10 lakh rupees per annum. If I'm going to add 1 lakh rupees per month, what is the tax amount that he'll be required to pay? And therefore, this has been made logical, wherein they say that it would be the least of actual rent payable by the employer or 15% of salary, right? So maximum what the income tax officer would tax here would be 15% of salary. So 12 lakh rupees of 15% of salary. Look at this. Isn't it very, very logical? You've got the valuation of perquisite, which is linked to the amount of salary as well as the actual rent paid. So actual rent paid of 15% of salary, whichever is less. Similarly, there could be furnished accommodation. Again, it could be employer owned. If it is employer owned, I'll just tell you the perquisite that you are supposed to tax. But then if it is leased, again, it becomes very simple. Now, if it is leased, you will pay the actual amount of rent. But when it comes to the furnished accommodation, what is different from unfurnished accommodation? The only thing is the element of furniture. Now, if the furniture is leased, you pay the actual charges. Whatever actual charges you're going to pay would be taxable in the hands of the employee. However, if the furniture is owned by the employer himself, it would be the amount of depreciation. Depreciation at the rate of 10% of the cost of such furniture, right? So 10% of the cost of the furniture would be treated as the furniture perquisite. Add to that the perquisite of unfurnished accommodation. Together, it would make perquisite of furnished accommodation, right? So this is clear, I suppose. We'll come to the rates of unfurnished accommodation in case where the accommodation is owned by the employer. In case of hotel accommodation, though, again, it is as good as leased accommodation. The employer would always know how much charges have been paid for accommodating that particular employee. So therefore, it would be actual charges payable for accommodating that particular employee in the hotel. But then you got to restrict it because Tata Group has got Taj Hotel. They accommodate a particular employee in Taj. His salary might not be commensurate to the cost of the accommodation, which is paid by that Tata Group company, and therefore they've restricted it to 24% of salary. Look at this. Unfurnished accommodation, the restriction is 15% of salary, whereas hotel accommodation, the restriction is at 24% of salary. So a little higher. The reason is more of value to the employee since he gets more facilities in a hotel and therefore 24% of the salary. Now, in all the three situations, whether it is unfurnished, furnished accommodation, or hotel accommodation, anything that is recovered from the employee would not form part of the value that is given to him, and isn't it? And therefore, whatever is recovered, whatever rent is recovered from the employee's salary would be not forming part of the perquisite. Now, coming to unfurnished accommodation provided by the employer to the employee. Now, this unfurnished accommodation is dependent on the area where the accommodation is provided. See, the area where the accommodation is provided would be important. Let's assume, you have got a particular accommodation in Mumbai itself, or, Delhi or Chennai. So you've got it in Kochi. You've got it in a big town. If you've got it in a big town, it is more valuable. So where the population exceeds 25 lakhs, if it is greater than 25 lakhs, such a accommodation is more valuable, and therefore the valuation of that accommodation which is owned by the employer would be 15% of the salary. See here, since it is owned by the employer, you would not have any rent charges, and therefore you'll have to determine based on the salary of the employee. It is 15% of salary. When it is located in a relatively smaller town, let's say it is located in Chandigarh, or where the population is greater than 10 lakh but lesser than 25 lakh. If that is the case, it is 10% of salary. The valuation of a particular accommodation in a locality which has got a less denser population would be higher than where the population is less. So if the population is less than 10 lakhs, well, in that case, it is only 7.5% of the salary. So here, in case of unfurnished accommodation owned by the employer, the valuation would be dependent on the population of the city where the accommodation is located. What you've got to understand here is this population got to be provided in the census of 2001 and not 2011. So we do have a census of 2011. However, explanation 4 still has not been amended, and we still have to follow the census of 2001. So whatever the population of 2001 is, it could so happen in an MCQ or a problem you have provided with a population of a town for both 2001 and 2011. You got to consider it for 2001 so far as rent-free accommodation is concerned. Well, I hope you're getting it. Now, as far as the value of furniture is concerned, we have already discussed it. If it is owned by the employer himself, it is 10% of the cost, which is the benefit of the employee. If it is leased, if it is leased by the employer, it is the actual hire charges. Now understand here again, one thing that I got to emphasize is, with this actual hire charges, we don't have a limitation. There is no limitation here. We had a limitation of 15% of salary in case of unfurnished accommodation. But as far as furniture is concerned, well, we do not have any limitation in respect of value of furniture. Right? So entire hire charges would form part of benefit flowing from the employer to the employee and would be taxed as perquisite. So moving further, yes, any questions, friends? You just have to go through the chart and you'll understand it in a better way. How further, we'll understand salary means for rent-free accommodation. What do you understand by the term salary? We've been talking of, basic plus DA plus fixed percentage of commission as a fixed percentage of turnover. For last two lectures, we've been talking of this definition of salary. However, for the purposes of valuation of perquisite, well, my definition of salary is a little broad. The reason why it is broad is because I want to tax more and I want to value the perquisites at a higher amount. A particular employee might be getting very little basic salary. His basic salary could be on a lower side. His dearness allowance could be on a lower side, but he could get a lot of other in-kind benefit, and therefore he's with the employer. Mostly, packages are designed in such a way where it is a proper mix of both cash benefit as well as in-kind benefit. In-kind benefits are very attractive to the family members of the employee, and therefore I keep the basic and the DA at a lower side, and I give an employee more of such in-kind benefit. Now, if that happens, well, what I got to do is I got to also take into account all the salary and not just concentrate on basic and DA. Hence, here the definition of salary includes all pay, taxable allowances, bonus, commission, whether that commission is as a percentage of turnover or given at a fixed amount, ad hoc amount, doesn't matter. All allowances, all pays, all entire bonus, commission, all the monetary benefits would form part of salary for the purposes of valuation. So again, fairly logical. What it does not include though, is DA if it is not forming part of the contractual obligation. So at times, once in a while, since there is a rising cost, employer could give a one-time DA, dearness allowance. Now that one-time DA would not form part of the salary. So unless and until it is obligatory on the employer to pay the DA and it is forming part of the retirement benefits, you're not going to include it. Similarly, employer's contribution to provident fund, allowances which are exempt, retirement benefits which are exempt, they would not form part of the salary. Salary includes pay, taxable allowances, bonus, commission, by whatever name called, or any other monetary benefit. So allowances which are taxable would also be included. What you don't have to include is the value of perquisite. So in-kind benefits, you're valuing in-kind benefit, and therefore you exclude in-kind benefit out of the definition of the term salary. Fairly logical. So it's a little broader definition. So we'll just discuss it. See what happens. There's a particular employee who was, located at Shimla. So Himachal, Shimla. Now, it is a beautiful place. And the employer gave him accommodation in an hotel in Shimla. He stayed there for, a couple of months, and he was working for the employer. he was accommodated in a hotel. Here, for whatever time he stayed, 24%, maximum 24% of salary would be his rent-free accommodation. So actual tariff charges paid by the employer or 24% of the salary, whichever is lower. And then, he was moved from Shimla to, let's say, Chandigarh somewhere. And there the population is lesser than 25 lakhs. He was given an accommodation in a city where the population is less than 25 lakhs. In Chandigarh, the amount of rent-free accommodation, the value of rent-free accommodation would be 10%, 10% of his salary. He's moved from Chandigarh to Mumbai. And now Mumbai has got a population of more than 25 lakhs. He's given a house in Mumbai. The valuation of this house would be 15% of salary. Now, this all, 10% of salary, 15% of salary would be applicable only if the accommodation is owned by the employer. If the accommodation is not owned by the employer, then you got to take the actual higher charges of that particular unit, subject to a maximum of 15% of salary. Here he has got a accommodation in Mumbai. See, while he was being transferred from Chandigarh to Mumbai, it took him some time to move all the material from Chandigarh to Mumbai. He has a family, and therefore he could actually need some more time. Let's say his children are studying and their academic year is about to end, and therefore he would have to keep the house of Chandigarh as well. And at the same time, he's moving the material. He's moving his furniture, his own personal effects to Mumbai, and therefore he also takes possession of the Mumbai property. Now he has got two houses, one in Chandigarh, another in Mumbai. Do you understand the situation? While he's on transfer, what happens is he has got one house in Chandigarh. Because there are certain factors, he has to wind up all his operations in Chandigarh and move to Mumbai. He took the possession of the Mumbai accommodation as well. Now, since he has got two accommodations, what happens is his value of perquisite would increase, because now two houses are going to be valued. In order to take care of a situation like this, it is a genuine situation wherein an employee got to be transferred from one city to another. In such a case, up to 90 days. See, up to 90 days. So this is an exception here. Up to 90 days, only one of the accommodation with lower value is going to be included in his salary. So either it would be Chandigarh or it would be Mumbai. Now, which is lower? Of course, Chandigarh is going to be lower, isn't it? So it is only 10 lakh rupees. 10 lakh is the population, and therefore only 10% of the salary. 10% of the salary would form part of the perquisite. So up to 90 days maximum, you are going to tax only one accommodation with a lower value in such a scenario where there is a shifting going on, right? Change in the posting. However, post 90 days, what would happen? If he doesn't leave the accommodation at Chandigarh, even after 90 days, in that case, both the accommodation would become taxable. Both got to be valued and both got to be added to his total income as perquisite. I hope you're getting this. Now, what happens? He stays in Mumbai for a long time, and thereafter he's posted from Mumbai to Rameshwaram. Right. Again, Rameshwaram would have a population of lesser than 10 lakhs. Lesser than 10 lakhs. And therefore, what happens when the population is less than 10 lakhs, my perquisite amount would only be 7.5% of salary. See, we have started with 10% of salary when it was 10 lakhs to 25 lakhs. Then we moved on to a city where the population was exceeding 25 lakhs. The perquisite was 15% of salary. And now we are in a very small town where the population is lesser than 10 lakhs. And therefore, my perquisite for an accommodation provided in Rameshwaram would only be 7.5%. Now, this particular employee, his name is Dr. Aryan. He is working on a project, between India and Sri Lanka. There is a structure called as Ram Setu. He's working on the Setu Samudram project. Let's assume that. Now, because of the Setu Samudram project, he has to work on high seas, in high seas. He's working between Sri Lanka, in the waters between Sri Lanka and India. Right? It is a remote location that he's working in. And therefore, he is also provided an accommodation, in the high seas. It could be we are talking of, understand friends, we are talking of a residential accommodation. Now, this residential accommodation need not always be a house. It could be, even a caravan, or it could be a ship. It could be a boat. It could be a cruise. So it could be anything. Just that it is accommodating that employee. Now, this employee is in the high seas and he's been given accommodation in one of the very good cruises while he's working there. Now, what happens in such a case? In such a case, you have got an exception. And the exception is if a person, I just show you the exception. I hope you're getting the crux. I hope you are getting, see, he's moving from Rameshwaram into the high seas. And in the high seas, you've got no facilities except for the facility that is provided by the employer. Now, what happens is when you are working in a remote location, and let's say it is, in this case, it is an offshore site. Since it is an offshore site and you're working in a remote area, the value of the accommodation is not going to be treated as perquisite. It is going to be exempt in the hands of the employee. Right? So Rameshwaram house, yes, it is going to be included in the value of the perquisite. However, from Rameshwaram to the high seas that he is working in, well, that accommodation is not going to be included. So exception number one is a mining site. So if the accommodation is provided in a mining site, oil exploration site, again, oil exploration, you all know, mostly it is into the high seas. Gas exploration, there are oil rigs within, in the middle of the sea, in the middle of the ocean. Project execution site, so any project that is being executed, there is a big factory that is that is being executed, and the employees are required to be kept at the site of execution. Well, in that case, there would be no valuation of perquisite. A dam site, a power generation site, or a offshore site, like we talked of while Dr. Aryan was working on the Setu Samudram project. So these all accommodations are going to be exempt. So exception is employee working in a remote area. Now, what is this remote area? Remote area is a location which is 40 kilometers away from a town with a population of 20,000. Right? So it is more than 40 kilometers away from any town, any town in the radius which does not have a population of 20,000. Right? Then accommodation of a temporary nature. On these sites, sometimes you get accommodation of temporary nature. You will have a tent, or you will have, kacha houses. So if it is so located, and if it is a temporary accommodation, up to 800 square feet of area, located at a distance of 8 kilometers or more of the municipal limit, in a remote location again. So 8 kilometers is the remote location for temporary accommodation. And if it is a mining site, oil exploration site, etc., the value of this temporary accommodation is not to be included for the purposes of calculating perquisite. I hope it is clear. Then we have already discussed exception when employee is on transfer and he has got two accommodation. If he has got two accommodation, For 90 days, he can keep both. Post 90 days, both are going to be taxed. Then sometimes government employees work on deputation. If government employees, as far as the government employee valuation is concerned, it is the license fee which is prescribed by the government. The government prescribes license fee for each of the accommodation. So, collect is given a house, the license fee is fixed as per the service rules. So, whatever the service rules prescribed as a license fee, that would be treated as perquisite in the hands of central or the state government employee. So, whatever license fee is prescribed in the service rules would become perquisite in the hands of that government employee. If any rent is actually recovered from the government employee, well, that is going to be deducted, right? So for government employee, it is the license fee. For other employers, well, you have to see whether it is owned by the employer. If it is owned by the employer, you've got three limits: 15% of salary, 10%, and 7.5%. If it is not owned by the employer and it is leased, well, you got to go by the actual lease rental paid by the employer or 15% of salary. We take a small example and we just understand each of the concept. See here, value of rent-free accommodation on my screen. I hope the MCQ is visible. We take up MCQs and we try and understand the concept again. Value of rent-free accommodation chargeable to tax in the hands of Mr. Harry. If Hogwarts pays a rent of rupees 5,000 per month is the question. But what are the details given? Harry is appointed as CEO of Hogwarts. He draws a salary of 10 lakh rupees per annum. So he's got a salary of 10 lakh rupees per annum from Hogwarts. He is allotted rent-free accommodation at Mumbai. Rent-free accommodation is provided to Harry at Mumbai. Now since it is at Mumbai, you already know that the population is greater than 25 lakhs. So maximum perquisite, could be 15% of salary. This is my maximum perquisite. But then he's provided rent-free accommodation on 1/4/2020, which he occupies from 1/10/2020. Let's make it 22. So he has got an accommodation on 1st of April 2022. However, he occupies that rent-free accommodation on 1st of October 2022. So for 6 months, he did not occupy the accommodation that was provided to him, since he preferred to stay with his uncle. Now, whatever the reason might be, if rent-free accommodation is provided to the employee and the employee is not utilizing that rent-free accommodation, well, he's not deriving any benefit. If he's not deriving any benefit, should he be charged for the perquisite? The answer is absolutely no. You're not going to charge it to perquisite, since Harry did not derive any benefit from such rent-free accommodation allotted to him from 1st of April 2022 to 30th of September 2022. Are you getting this, friends, everybody? So tell me, what would be the amount of perquisite in the hands of Harry? Yes, let me see a few answers. His salary is 10 lakhs. He's occupied the accommodation from 1st of October 2022. And Hogwarts have paid a rent of 5,000 per month for such accommodation. Value of rent-free accommodation in the hands of Harry. All right, I've got one answer from Kirti. Okay, Bhumika says it's 75,000. Priyanka says it's 30,000. Kirti also says it's 30,000. Any more answers? Varsha says it's 30,000. Okay, Ishan, Sudhanshu, what you have to say about this? Vardha says it's 75,000. Diksha 30,000. Okay, we have got a few answers. Well, friends, look at this. The information given to you is Hogwarts have taken the premises on rent. So since they've taken it on rent, the valuation would be rent actually paid by Hogwarts or 15% of salary, whichever is less. This 15% of salary does not change in a case of a rented accommodation, even if, irrespective of the city which the accommodation is located. It is always 15% of salary. So rent actually paid or 15% of salary. Now, rent paid by Hogwarts is 60,000, for the entire year. However, for all the 12 months. However, Harry did not take benefit for the first 6 months, and therefore he should be charged only for the next 6 months. So for next 6 months, Hogwarts have paid 30,000 rupees in rent. 15% of his salary for that relevant period of 6 months would be 5 lakhs multiplied by 15%. So it would be 75,000. So 30,000 or 75,000, whichever is less. So we go with 30,000. Yes, wonderful. A lot of you have answered it well. It is going to be 30,000. Understand? So it is not 60,000 rupees and it is not 75,000 rupees definitely. It is 30,000 or 75,000, whichever is less. Do you get it, friends, everybody? So don't miss out on, smaller details. It was a very, very simple MCQ. Probably you would have missed out a couple of very good marks, which otherwise you could have scored if you would have read the question well. Then let's go ahead. Here you have got another MCQ. What would be the value of rent-free accommodation chargeable to tax in the hands of Mr. Harry if Hogwarts paid rupees 50,000 per month in rent? Now his salary is 10 lakh rupees. Hogwarts is paying 6 lakh rupees in rent. Now what would have been the perquisite taxable in the hands of Harry? See, try this out. This is pretty simple. Value of rent-free accommodation chargeable to tax in the hands of Harry if Hogwarts actually paid a rent of 50,000 per month for his accommodation in Mumbai. So the rent paid by Hogwarts is 6 lakhs. Salary of Harry is 10 lakhs. So 6 lakh rupees or 10 lakh or 15% of 10 lakh, whichever is lower, right? But then don't forget about the fact that Harry did not have the possession, did not take the possession of the rent-free accommodation until 1st of October 2022. He preferred to stay with his uncle until then. So until then, till he actually derives benefit, you're not going to include that period because no value was derived by Harry. So Dinesh, you made an error there because see, for the 6 months, Hogwarts have paid 3 lakh rupees of rent. For the same 6 months, you know, Harry has derived a salary of 5 lakhs from the period 1st of October 2022 to 31st of March 2023. Harry has got salary of 5 lakhs. 15% of 5 lakhs would be 75,000. So 3 lakhs or 75,000, whichever is less. So yes, Varsha, your answer is correct. It is 75,000. It is, and the answer is A, 75,000. See, understand this? The answer would be A, 75,000. See, are you getting it? Why 75,000? 15% of the salary also got to be considered only for the 6 months and not for the entire year. If you do not consider only the relevant period, what would happen is, friends, let's say Harry had occupied the house only for 1 month. Would you still tax him for the entire years of salary? The answer is no. You will take salary only for that 1 month and not for the entire year. Okay, let's move to the third one. Value of, so everything remains the same. Value of rent-free accommodation chargeable to tax in the hands of Harry if the house is owned by Hogwarts. Now we don't have a lease rental. We don't have the lease rental. The house is owned by Hogwarts itself. What is the amount of the value of rent-free accommodation? Well, the location of the house is at Mumbai. Mumbai has got a population of greater than 25 lakhs, and therefore my valuation would be 15% of salary whenever the accommodation is owned by the employer. Now, 15% of salary, 10 lakh rupees per annum is his salary. Therefore, the total value of the accommodation would be 1,50,000 for the entire year. However, we are talking of only half of the year, and therefore, here also the value of rent-free accommodation would be 75,000. Therefore, I would go with answer C, right? Let's move on to the next one. Value of rent-free accommodation if Harry is provided an accommodation in Taj Hotel for which Hogwarts paid rupees 3 lakhs for the period of stay. Now you actually know how much Hogwarts have paid. You can quantify the value that Harry has got from the hotel accommodation because you are aware Hogwarts have paid 3 lakhs. However, we got to restrict it to 24% of salary. So if Harry would have stayed for the entire year, my total valuation should not have gone up by 2,40,000. So maximum 2,40,000. But then Hogwarts have paid 3 lakh rupees for 6 months. sorry, for the entire year, but Harry has taken benefit only for 6 months. Hogwarts have paid for the entire year because they've taken the accommodation in Taj Hotel. However, Harry took benefit only for 6 months, and therefore my my value of per visit would be 2,40,000 multiplied by 6 months divided by 12 months. So one half of 2,40,000. Fantastic. So it would be 1,20,000. Yes, a lot of you have answered it. Arya, Priyanka, Bhumika, wonderful. Let's move on to the next one. See, value of rent-free accommodation. If the accommodation was provided in Taj Hotel and Hogwarts paid only rupees 1 lakh for the period of stay. Now what happens? Let's say Hogwarts have also taken the accommodation on 1/10/22 and they have paid 1 lakh for, let's say, 6 months. Okay. Now in this case, it is the actual amount expended or 24% of salary, whichever is less. So it would be 1 lakh rupees actually spent by Hogwarts or rupees 1,20,000, which is 24% of the salary for the similar period. And therefore the answer is going to be B. Wonderful, wonderful. A lot of you have answered it well. So this is it. Don't miss out on the detail. You just have to read the question carefully. These were very simple questions. I've made these questions for the purposes of better understanding of the provision. You would never get a simple question like this mostly. But then even in the simple question, sometimes we tend to do an error because we don't read it carefully. You have to get into the details. Okay. Now, so that was all about rent-free accommodation. Let's move on to the next one. See, sometimes benefits and amenities are provided to employees, and these in-kind benefits might, the value of these in-kind benefits could be substantial. So a particular employee may get a helper, usually in the army or with railways, you get helpers. Even the domestic help is provided by the employer. So there are a few officers, high ranking officer who do get domestic helpers like sweeper, gardener, watchman. So these are given to the high ranking officers who are posted in sensitive areas or at remote location. Now, these services of sweeper, gardener, watchman are indeed benefit to that employee because with or without the help of the employee would always need some domestic help. He would need a sweeper in the house, he would need a watchman at the house. And therefore, these benefits are of a nature whereby the employer is, in a way, making up for the obligation of the employee. So, sweeper, he would have employed if the employer would not have provided. But then, since the employer has provided with a sweeper to the employee, well, what happens? The employee gets an advantage. Now, there are certain items of benefit or amenities which are taxable only in case of specified employees. Now, who are these specified employees? Virtually anybody. Virtually anybody. I'll explain in a short while why. However, virtually anybody would be a specified employee, and if at all he gets any benefit, then or amenity of a specified nature, then it would be taxed in his hand, right? Provided he's a specified employee. Now, who is a specified employee? One, a director employee. So managing director is a specified employee. Two, a person, an employee who has got substantial interest within a company. So substantial interest means what? 20% or more of voting rights, right? So one who has got substantial interest. See, these two categories, A and B, are of those employees who are in a power position. A director would, would put an influence to design his own pay package. Director is influential. He could design his own pay package the way he wants to. Similarly, a person having substantial interest, one who has got 20% of voting right, he can sway the decisions of the company, and therefore he's a specified employee. The third category, engulfs everybody virtually. See what they say further. So any value of benefit or amenity. So we are again talking of value of any benefit or amenity provided free or at a concessional rate by any employer to an employee. We are talking of value of benefit provided by an employer to any employee, to an employee whose total income under the head of salaries, exclusive of the value of all benefits and amenities. So excluding perquisites, excluding what we are talking of, right? Excluding all the perquisites provided under section 17(2), his income under the head of salaries exceeds 50,000. Now, which employee would get lesser than 50,000? Most of the employee who's getting benefit free or concession at free or concessional rate, one who's getting a sweeper, gardener, watchman, etc., or educational facility, most of them would have an income under the head of salaries exceeding rupees 50,000, right? So therefore, what I meant to say is it engulfs everybody. Specified, most of them would be specified employees. However, important to understand that the definition of specified employee has got director employee irrespective of the amount of salary that is paid, an employee who has got substantial interest irrespective of the monetary limits. However, in respect of all other employees, that is one who is not a director employee or one who does not have a substantial interest, only if the salary, only the income from salary exceeds 50,000. If it exceeds 50,000, the value of the benefit is going to be included. What if it does not exceed 50,000? Then we are not going to charge any of these benefit or amenities in his hand, right? For a low paid employee, for an employee who doesn't have substantial amount of salary, if he has been given some benefit, now that benefit is not going to be taxed in his hand if the salary income is below 50,000, right? So if it does not exceed 50,000 and it is income under the head of salaries, understand, it is income under the head of salaries, and therefore you have to also provide for standard deduction while you compute salary for deciding whether a person is a specified or a non-specified employee. You also got to provide for standard deduction of 50,000 and also the entertainment allowance and the professional tax deduction to the extent of 2,500, right? So these are a few specified employees, 3 specified employees. Now moving further, so what is taxable as perquisite under this head? Well, it is services of sweeper, gardener, watchman, supply of gas, electricity, educational facilities. You've got car, leave travel concession, medical facilities. These are going to be taxed only in the hands of specified employees. See, I'll just take an example. How do you value these benefits? We'll come to it in a short while. We have to go to rule 3 in order to value these perquisites. But then these perquisites are taxable only in case of specified employee. Here you've got one of the example. You'll understand why it is important to understand specified employee and why directors or somebody with substantial interest is specifically included within the definition of specified employee. Here, Jeff is an employee director in Blue Origin with 19% voting power. Now, he's a director. He's also a shareholder. and he is also an employee. So he's a managing director of Blue Origin with 19% voting power. So it is lesser than 20%, right? Are you getting it, friends? We have to figure out whether he's a specified or a non-specified employee. See, value of benefit granted by a company to an employee with substantial interest. Whether he has got substantial interest, the answer is no. Substantial interest would mean at least 20% of voting right. He doesn't have 20% of the voting right. He has planned it in such a way that no, I do not want 20% voting right. I'll have 1% less. Now, Jeff is paid rupee one as salary by the company. Indeed, there are a lot of CEOs who charge only 1 rupee as salary. Why the company is not doing well, or they want to contribute more to the company, they'll charge only 1 rupee. You'll come across such news more often than not, that a particular CEO has charged only 1 rupee because it is difficult time for the company. Jeff charges only 1 rupee as salary. You know, Jeff has charged only 1 rupee. And therefore, if this particular point A is not considered, if you do not consider point A, point B, he satisfies the condition that he doesn't have the substantial interest. Point C, he satisfies the condition, his salary income is below rupees 50,000, right? Income under the head of salary below rupees 50,000. However, he gets amenities like motor car, medical facility, gardener, travel to space. So he's got so many advantages out of Blue Origin. He claims that only rupee 1 is taxable. Is he correct? The question is, he claims that it is only 1 rupee that is taxable, whether he's right in saying so. The answer is no. He's a director employee. He is in a position to provide as many facilities that he wants to. And therefore, since he's a specified employee, the value of these benefits, amenities would form part of his salary and not rupee 1 alone. So you are going to include even the perquisite amount apart from rupee 1, give standard deduction of 50,000. That is available to everybody, right? And rest of it would be taxable. So see the options there. So when you look at the provision, in real life, also you can compare it with a particular situation, and you'll realize that the provision is made or evolved having regards to the real world. So most of the time, provisions do get amended just because somebody has found a loophole. So Jeff was trying to find a loophole here by taking a salary of only 1 rupee and taking all the other benefits from the company in form of sweeper, etc., medical facilities, gardener. And had he not been a specified employee, it would have been exempt. Although I feel that 50,000 rupees is too small a number. The amount should be increased to 2.5 lakh rupees at least. But then as it stands today, it is only 50,000. One thing which this particular clause clarifies, 17(2) clause 3, it clarifies that vehicle provided by the employer to the employee for commutation from residence to office or any other workplace would not be treated as perquisite. So, place of residence to the place of office. If the vehicle is provided by the employer, it is not perquisite. See, if an allowance is given by the employer to the employee for commuting from place of residence to the place of office, it is taxable allowance. However, if the vehicle itself is provided by the employer, then it is not to be treated as perquisite. If you remember, we did discuss transport allowance. Transport allowance is exempt only in case of those employees who are physically handicapped. And that too up to rupees 3,200 per month, right? For all other employee, it is taxable. But if vehicle is provided, then it is exempt. So most of the time, employees are required to work late. In the BPOs, especially the those who are running call centers, etc. They work late night, and therefore the employer is supposed to give them facility to commute from the place of residence to the place of workforce. That is not um, a benefit or an amenity, but it is something necessity, right? Let's move further. I hope you got the MCQ of Jeff. Okay. C is the answer for this. No, being a director in the company is a specified employee and the value of benefits would be taxable. Now, moving further. So let's see what are the benefits which are covered by section 17(2)(3), which are taxable only in the hands of specified employees. We move on to the next benefit, which is again very, very common, and that is motor car. Usually, conveyance is provided, a mode of conveyance is provided to employees who are at a good designation. Now, this is taxable. This benefit by way of a motor car, which is an in-kind benefit, is taxable only in case uh, of specified employee. Specified employee is again director or one who holds substantial interest in the company, or the one who has a income from salary exceeding 50,000 rupees. If he is provided with a motor car, you got to value the car. Now, how do you value the car? Well, I'll just show you a picture. Now here you've got three kinds of car. You've got car A, car B, and car C. In car C, the employer has also provided a driver or a chauffeur, as they call it under the Income Tax Act. A chauffeur is also provided along with car. Now, which is more valuable, whether A or whether B? Amongst A and B, you would always say that B seems to be valuable. Looks bigger and looks more powerful, and therefore I need a car that is B. But then if I need, I get a car B along with a driver. Now that is more valuable than getting merely car B. So as good as this. So you've got to figure out how big is the car, what are the other advantages you get with the car, and you've got to find out the real value. Now, if I told you that the car is used only for official purposes and for no other purpose, let's say there's a police officer and he could use a car only for official purposes, only while he's raiding a particular premises. In that case, that police officer would not get any advantage out of that car because he's using the car only for official purposes, right? So if he is using it only for official purposes, no personal advantage is derived, and therefore there could be no perquisite, right? So the purpose of use of the car would become important. Now, assuming that the car is used by the employee and he is using it entirely for personal purpose only and not for official purposes at all. If he is not using it for official purposes, the entire amount would be taxable in his hand as perquisite, right? What happens if he uses it partly for official and partly for personal purpose? This is where the real tussle lies. How much for personal and how much for official? The real complexity is where a particular car is used for both personal as well as official purposes. With this in mind, let's move ahead. You now know which is more valuable and how it is going to be taxable. So if it is used for personal purposes, if the car is used for personal purposes, only then it would be taxed. If it is used entirely for official duty, well, there is no value of perquisite. Now, a car can be owned or hired by the employer. So either it is owned by the employer himself, like the rent-free accommodation. Rent-free accommodation was owned by the employer or it was hired by the employer. If it was hired by the employer, you know the higher charges. You know what is the rent that you're paying. However, if it is owned by the employer, in that case, you're not aware of the higher charges. You would what you would know is the normal wear and tear or the depreciation. You would know the depreciation of the motor car and the expenses on running of the motor car. Do you agree with me? If it is owned by the employer, provided to the employee, there are two expenditure. One is the expenditure of depreciation, and the second one is the expenses on running and maintenance, of that motor car. If it is hired, you have the higher charges and the expenses of running. Second scenario could be that the motor car is owned by the employee. So either it could be owned by the employer or hired by the employer, or it could be owned by the employee. If it is owned by the employee, then this element of depreciation would not be there. Employer would not have to incur anything. It is anyways which owned by the employer, and therefore at the most what the employer could do, employer could reimburse the expenses on running and maintenance of the car, right? Now, if it is for official duty, then there is no perquisite in both the cases. Whether the car is owned by the employer or employee doesn't matter. Once a car is used strictly for official purposes, mostly in case of government employee, you have a car which is used strictly for official purposes, then there is no value. The perquisite would be zero. However, if it is used only for personal purposes, if a particular car is used only for personal purposes, in that case, where it is owned or hired by the employer, you got to take the actual expenditure of the employer, including depreciation. So simple. Very simple. You have got, the actual expenditure incurred by the employer for providing that car. It would be petrol expenses. It would be, repairs and maintenance. It could be insurance. So actual expenditure of that car, inclusive of depreciation, which is 10% of the cost. 10% of the cost of the car would be treated as normal wear and tear and would be included, notionally would be included as your perquisite. Then comes the real challenge, partly for personal. So if it is fully official, no problem. But if it is partly official and partly personal, then I have got a problem. Now, how do I segregate both of them? Well, very difficult to segregate, and therefore, I divide it into two. If at all the running and maintenance is made by the employer. The running cost is made by the employer, even for the personal purposes. Even for the personal purposes which the car is being used for, it is the employer who is expending. And the second category is that the running expenses for such personal purposes is made by the employee. So you've got car which is provided by the employer. However, whenever the car is used for personal purposes, the expenses of that personal travel in that motor car is being met by the employee. Now, which according to you would be more precious? Well, if at all the employer meets all the cost. When employer meets all the cost, in that case, what am I going to do? I'm going to charge 1,800 rupees per month. Sorry, not 18,000, 1,800 rupees per month as perquisite, as perk for the personal use. Are you getting this, friends? See, I'm going to charge 1,800 rupees per month as perquisite for personal use of motor car. When the car is owned by the employer, hired by the employer, and running and maintenance cost is also met by the employer, right? The personal element is 1,800 rupees per month. Now, what they've done here is they have intelligently divided the car, classified the car into a high-end car and a basic car. If it is a basic car that is having a cubic capacity of 1.6 liters. So, 1600 cc, lesser than 1600 cc of a car. So usually Alto, something like a Alto or a Wagoner, a small car. If it is a small car, then you pay 1800 rupees per month. But if it is a bigger car, greater than 1600 cc or 1.6 liters of cubic capacity, in that case, you are given a good sedan, let's say Honda City or something like a Cybertruck. Well, in that case, it is 2400 rupees per month. So higher perquisite, it is up to 1600. It is 1800 rupees per month. 1.6 liters, it is 1800 per month. More than 1.6 liters, it is going to be 2400 per month. But if the employee does all the expenditure for his personal purposes, it is not the employer paying for it. He derives lesser benefit. Employee is paying for his personal trip. In that case, this 1800 is replaced by 600 per month. Why? Because the employee meets all the expenses. And therefore, I should be charged only for the car and not for the expenses. And therefore, 1800 reduced to 600 and 2400 reduced to 900 rupees per month if at all the employer does all the expenditure for the personal travel. Do you get this, friends, everybody? So simple. Now, if a chauffeur is provided, if a driver is provided along with the car, in that case, whether the expenses are incurred by the employee or the employer, rupees 900 per month is added to the value of perquisite of the employee towards this driver, right? However, it is only this 900 rupees would be added only if the car is used partly for personal or partly official. If it is used fully for personal use, in that case, the actual salary paid to the driver, driver's entire salary is going to be treated as perquisite. Understand this again carefully. If the car is used fully for personal purposes, the entire driver salary is perquisite in the hands of the employee. If it is used partly for personal and partly for official purpose, only then 900 rupees per month is added towards driver. So let's say he gets a Alto along with a driver. In that case, his perquisite would be 1800 rupees plus 900 rupees of driver salary. That is 2700 rupees of perquisite, right? Getting this, friends? Now, if the car is owned by the employee, what happens when the car is owned by the employee and it is used partly for personal and partly for official purposes? If it is used fully for personal purposes, owned by the employee, used by the employee, whatever the expenditure done by the employer would be taxable in the hands of the employee. However, when it is used partly for personal and partly for official purposes, then comes the real challenge. And therefore, they've said that if the car is owned by the employee and it is a small car, you got to take the actual expenditure incurred by the employer. Only if there is an expenditure incurred by the employer would there be a perquisite and reduce therefrom. So whatever expenditure, let's say my employer has expended 10,000 rupees, for the car that I own, and I use it both for my personal purpose as well as for my official purpose. So this 10,000 rupees is the value of perquisite. However, I've also used it for official purposes and therefore some allowance got to be given to me. Therefore, they say if your car is up to 1.6 liters, 1800 rupees would be deducted out of the total expenditure. 1800 rupees would be deducted towards my official purpose, and rest of it would be taxed. 8,200 rupees would be taxed as perquisite in this case, since 10,000 rupees was the actual expenditure. Right. So here we have found out the element of personal value. Right. Here we are finding out the element of personal value by deducting official value. The amount of expenditure done for official purposes. So 1800 rupees per month or 2400 rupees per month if the car is above 1.6 liters of cubic capacity. Do you get this, friends? Simple, right? You have to just go through the diagram once more and you'll understand this. We take up a few examples to understand the concept well, but for the time being, I hope you're getting it. What happens if it is not a car but an other vehicle? If it is an other vehicle, this 1800 and 2400 is reduced to 900 rupees per month. Let's say a particular employee gets a motorbike and not a motor car. In that case, it would be 900 rupees per month. Whatever amount is recovered from the employee would be reduced out of the amount of perquisite. So that is there always. So if a particular employee is paying something, for the personal use, that has to be reduced. Now, okay, food for thought, friends. Nowadays, we've got EVs, EVs, electric vehicles. Are you aware of them? Electric vehicles, a lot of cars are now EVs. And you don't have this cubic capacity of 1.6 liters and greater than 1600 cc, etc. There is no cubic capacity because there are no cylinders and there is no fuel. Actually, what the fuel is, the battery. And therefore, this rule needs to be changed now. There is a strong reason why Rule 3, Sub-Rule 2 should be changed, because it doesn't consider EVs. What would happen to the valuation of EVs? I really don't know what is going to happen. But something like a Tata Nexon. Now, if I happen to see Tata Nexon, they would say that it has got a capacity of 40.5 kWh. Now, there is no CC involved there. So this entire mechanism would fail as far as valuation of a EV is concerned. Watch as to what happens to an electric vehicle. Now you'll have to go to use of movable asset. We'll see another type of perquisite wherein use of movable asset is also taxable as perquisite. The valuation norms are different. But certainly EV would not fit in this particular rule, that is motor car. Right? Getting this, friends, everybody? Let's take this by way of an example. We take an example and then we take a short little break. See, Harry is provided with a Cybertruck, a car with a power of 200 cc, 2000 cc. So 2000 cc is 2 liters of engine capacity, right? 2 liters of cubic capacity. The cost of car is 10 lakhs. So we are aware about the cost of the car. Now, when you are given cost of the car, the value of depreciation or the wear and tear. The normal wear and tear would be 10% of the cost, right? So even if it is a 100-year-old car, you got to take cost, right? The monthly expenses for maintenance of the car are 5,000 rupees, which is fully met by Hogwarts. Rupees 12,000 is recovered from Harry. What is recovered from Harry is 12,000 rupees, and the car is costed at 10 lakhs. Value of car if it is used partly for official and partly for private purposes. You got to figure out if the car is used. See, the Cybertruck is owned by Hogwarts and the car is used partly for official purposes and partly for private purposes. What is the amount of perquisite if 12,000 rupees is recovered from Harry? Now we recovered 12,000 from Harry. Yes, 2000 cc of car owned by the employer, used partly for personal and partly for official purposes. The running and the maintenance cost is 5,000 rupees per month. Irrelevant information. Both 10 lakh rupees cost of car and also the maintenance cost of the car of 5,000, which is given in the problem, becomes irrelevant the moment it is partly personal and partly official. In fact, even the amount of recovery done by Harry becomes irrelevant. Why? Because we are concerned with, partly personal, partly official, where the running and the maintenance cost is met by the employer, and the car is to the tune of 1.6 liters, more than 1.6 liters of cubic capacity, and therefore the valuation of the perquisite would be 2,400 rupees per month multiplied by 12 months. 2,400 per month multiplied by 12 months. See here, it is partly official and partly, partly official and partly private purposes. And therefore, indeed, it is 2,400 rupees per month, since it is a 200 cubic capacity, sorry, 2.2 liters of cubic capacity multiplied by 12, which is, I guess, 28,800. Yes. So D is the right answer. Yes. I hope you're getting it. 28,800. Wonderful. Let's move on to the next one. Okay, this is interesting. Value of car if it is used by Mrs. Ginny, wife of Mr. Harry, for personal purposes. Now the car is given by the employer to the employee and it is used entirely for personal purposes. There is no official purpose involved, right? So again, going by the chart, just have to go by the chart and see it is fully personal purposes. No part of it is used for official purposes. Usually what happens sometimes for a very high ranking personnel, the official car is different from the personal car. Meaning what? Multiple cars are provided to a particular employee. If multiple cars are provided, only one of the car could be treated as partly personal, partly official. The rest would always be treated as personal purposes. So if at all a particular employee is provided with two cars, one would always be treated as personal. Only one car could be treated as partly official and partly personal. If I want the car to be treated as completely official, I got to keep a logbook that yes, this car is used only for official purposes. A documentation should be kept with the details of the journey of the use of the car, and also you got to get it certified from the employer that the car has been used only for official purposes and not for any other purpose. So usually government employees do keep a log of where the car has been taken. Those employees who are into defense services or police service, in that case they'll keep a log where the car has gone. Okay, Harry is provided with a Cybertruck, a car with 2,000 cc of power. The cost of the car is 10 lakh for Hogwarts. Well, yes, Vaishali, you are bang on right that in the problem it is not mentioned whether the car is owned by the employer or the employee. Well, I give you an information that it is owned by the employer. Owned by the employer. We'll see what happens if it is not owned by the employer. The monthly expense of the car are 5,000, which is fully met by Hogwarts. Rupees 12,000 is recovered from Harry. So this is interesting. And Vaishali says it is 1,48,000. Priyanka says it's 60,000. I give you a shot of how the valuation is done. Whenever car is owned or hired by the employer for personal purposes when it is used entirely for personal purposes. Sorry. When it is used entirely for personal purposes, no part of it is official. You got to take into account the actual expenditure. Now, what is the actual expenditure? We are told that 5,000 rupees is the actual maintenance expenditure, right? So 5,000 into 12, that is 60,000. And what we also know is the car is valued at 10 lakhs. The cost of car is 10 lakhs. So 10% of that would be 1 lakh rupees of depreciation. So actual expenditure, including the normal wear and tear. So my total cost, total value would be 1,60,000. However, what Harry has already paid for is 12,000. The recovery from Harry is to the tune of 12,000. And therefore, the real benefit which Harry got was 1,48,000. Do we have that option? Yes. So A is the right answer, 1,48,000. Let's move on. So value of car if the Cybertruck is owned by Harry. So here you go, Vaishali. What happens when the Cybertruck is owned by Harry? Diksha, Bhumika, do you get why 1,48,000? Because 12,000 rupees have been recovered. So 160 is right. But since there is a recovery, you got to deduct that. Value of car if the Cybertruck is owned by the Harry and used for partly for private and partly for official. Now, when a particular car is owned by the employee and it is used for partly official and partly personal purposes, you got to take the actual expenditure. What is the actual expenditure of the employer? The actual expenditure of the employer is 5,000 rupees per month, right? So maximum value that the employee has got is only 60,000 rupees. But then since it has been used for both private as well as official purposes, I got to reduce the value of the official purpose. So what is the value of official purpose? They say it is 2,400 multiplied by 12, since it is a car above 1.6 liters of cubic capacity, right? 1.6 liters of cubic capacity. And therefore 60,000 minus 2,400 multiplied by 12. So what is the amount of perquisite? What is the amount of perquisite, friends? 60,000 minus 28,800, I suppose. So it would be 19,200. C should be the answer. Sorry, not C. B. 31. 60,000 minus 28,800. That is 2,400 into 12. So it is 31,200. Yes. So B is the answer. B and not C. Vaishali, sorry. It is C. See, what is the amount that Hogwarts have spent? Hogwarts have spent 5,000 rupees multiplied by 12 months, which is 60,000. And this is the total expenditure, both for private as well as personal. I got to deduct both for official and personal. I got to deduct the official expenditure. Official expenditure, therefore, is 2,400 per month multiplied by 12. Now, this is notionally given to us. This is notional expenditure, right? 2,400 fixed minus 28,800, therefore. So answer is B. I hope you all get it. Oh, yes. Sorry. Yes. One thing that I missed out was Recovery of 12,000 rupees from Harry. If at all any sum is recovered, yes. If at all any sum is recovered from the employee, that got to be deducted. No, you miss out on detail and marks gone. So I would have lost a few marks. So yes, 19,200. Wonderful. Yes, Dinesh, you are absolutely right. So it is 31,200 minus 12,000. Yes. So there is a amount recovered from Harry of rupees 12,000. Okay. Let's move further. Yes, Vaishali, you were right. My bad. I just forgot that 12,000 rupees of information. Let's move to the last one. Value of car if the cyber truck is used for official purposes and for commuting from residence to office and back. That is what the cyber truck is used for. It is used only for official purposes and for commuting from residence to the office and back. See, I have already discussed that whatever value of perquisite, just a second, whatever is the perquisite arising on commutation, vehicle provided by the employer for commutation of employee from residence to office, or any other workplace would never be regarded as a benefit or an amenity. It is more of a necessity. And therefore, the car here, the cyber truck here is provided for both. One is official, fully official, and the other is for commuting from residence to the office and back. This part of the story, though it is not official, though it is there is some personal element involved because you have come to the office, you have to go back on your own, you will have to go back. But then yet, since it is deemed to be not considered as benefit, well, the valuation would be nil. Yes, yes, Diksha, you're right. It would be nil. Nothing is going to be taxed as perquisite. Nil. Great. All right, friends, we take a short break of 5 minutes. I know I've taken more time today. We take a short break of 5 minutes. Come back again. We have a few rules to check out. Uh, as far as rent-free accommodation, motor car is concerned, these are two very important ones. You could have them in problem. There are a few smaller rules also, which are easy to understand. We'll just skip through them quickly, and then we move on to one important perquisite type, and that is the ESOPs, the Employee Stock Option Program. So that is the area which has also seen amendment in the recent past. So Finance Act 2020 did amend the taxation of ESOP in case of startups. We will discuss that, but prior to that, we'll discuss all the smaller provisions. All right, take a short little break of 5 minutes, come back again. Good, great friends, welcome back. I know it was too short a break, but then look at this. Let's move to the next set of perquisite or next set of benefits. Rule 3.3 deals with provision of services. See, what we have is provision of services, friends. If at all employer provides any services in the nature of, by way of giving a sweeper, employing a sweeper at the employee location, wherever the employee stays, a sweeper is given to his household, or a personal attendant, PA is provided, or a gardener, or a watchman, you know, either of the employees, or it could be anything else, whatever helper is provided by the employer to the employee is in the nature of benefit, right? In-kind benefit. Here, what happens is the employee doesn't employ the sweeper or the personal attendant, watchman, or the gardener. This sweeper, gardener, watchman is employed by the employer. But for whose benefit is he working? The sweeper would be working for the benefit of the employee, right? And therefore, the value in the hands of employee would be the actual cost incurred by the employer. The salary that is paid by the employer to the sweeper. So it is, very simple to understand. But then, friends, understand that this particular benefit is taxable only in the hands of a specified employee. So a non-specified employee drawing salary of, let's say, 80,000 rupees, if he is provided with a sweeper, right? 80,000 rupees is the gross salary. Standard deduction would be 50,000, and therefore his income from salary prior to considering the perquisites would be 30,000. Since his salary is 30,000 rupees, which is less than 50,000, the salary paid by the employer to the sweeper, which is provided to an employee with a salary of 30,000 rupees per annum, would not be included in his total income. It would not be included as perquisite in his salaries, right? Do you get this? So it is taxable only in case of specified employee. This is something you've got to remember. Then, now at this juncture, I wish to bring to your notice there one more section 17.2 IV, what it says and how it overlaps. How the provision of 17.2.3 and 17.2.4 overlap each other. I'll just let's go through 17.2 IV. Obligation of the employee borne by the employer. You tell me, whose obligation was it to employ a sweeper in the household? It was the obligation of the employee and not the employer, right? Whose obligation is it to provide education to children of the employee? It is employee's own obligation. But if the employer is bearing the cost of that education, well, it is the obligation of employee borne by the employer, right? Are you getting my point? Obligation of the employee borne by the employer. It is any obligation of the employee which is borne by the employer would be treated as perquisite, right? Any obligation of the employer borne by the employee would be treated as perquisite and taxable in the hands of the employee, right? And it is taxable in the hands of all the employees and not just specified employee. Now, how this is distinct, how 17.2 IV is distinct from 17.2.3. See, 17.2 III deals with only benefits provided to specified employee. However, 17.2 IV deals only with, deals with all the employees in respect of obligation of the employee discharged by the employer. Now, with keeping this in mind, let's go to rule 3.4, right? 3 sub-rule 4. Rule 3 sub-rule 4 deals with supply for household consumption of gas, electricity, and water. See, if the employer provides electricity, water, or gas to the household of the employee, the amount expended by the employer to get any of the services, the actual cost of the electricity, the actual water charges paid by the employer, the actual charges paid for the gas, purchased by the employer, would be taxable as perquisite. However, this perquisite is again taxable only in the hands of specified employee. But then we have got 17(2) IV. What it says, obligation of the employee borne by the employer. The employer taking electricity connection and pays for the electricity charges. The employer in this case, employer employs a sweeper and gives it to the employee. These are in-kind benefit. Understand, these are in-kind benefit. However, situation would change if the employee himself employs a sweeper, and the charges of the sweeper. Let's say a sweeper is employed by an employee for ₹3,000 per month. Now it is the liability of the employee. Since he has employed this sweeper, it is his liability to pay the sweeper ₹3,000 per month. Right? He is entitled to it. It is his obligation. The employer only reimburses. The employer reimburses ₹3,000 per month. Now, this reimbursement is chargeable to tax in case of all the employees. So, whether this particular employee here is a specified employee with drawing ₹30,000 of salary, but if he has employed the sweeper, if the employee has employed the sweeper, it is his obligation which the employer has discharged, which the employer has borne. Therefore, this particular arrangement would fall under 17(2) IV. However, if it was the other way around, that the employer had employed a sweeper and provided that sweeper to the employee, it would be chargeable to tax as perquisite only in the hands of the specified employee. So do you get this, friends? Everybody, the distinction between 17(2) III and 17(2) IV. So it depends on whose obligation it was. Right. So if it was an employer obligation to pay the sweeper or pay the electricity charges, in that case it is taxable only in case of specified employee. Else it would be taxable in both the cases, both specified as well as non-specified. Now, so actual cost of electricity, gas, and water. Sometimes what happens, a particular employer could have an electricity company. There is an electricity generation company, and it has got its own employees. Now they provide electricity to the employees who are working in that electricity company free of cost. Now, how do you find out what is the amount actually incurred? Well, it is simple. You got to find out the manufacturing cost. If the employer himself has got the resources, electricity, gas, or water, in that case, the manufacturing cost of the electricity would be treated as perquisite, or manufacturing cost of the gas or the water would be treated as perquisite in the hands of the employees. Do you get it, friends? Everybody? See the distinction between 17(2) IV and 17(2) III. Very, very important. I've seen a couple of times where a question has come on 17(2) III and 17(2) IV. The distinction between the two is simple. Whose obligation is it? If the sweeper is employed by the employer, well, it is not the obligation of employee to pay, and therefore it would be taxed only in hand of specified employee. However, if the sweeper is employed by the employee himself, it is the employee's obligation covered by 17(2) IV, right? Taxable in all the employees, not just specified. So moving further, Rule 3, Sub-Rule 5 deals with provision of free or concessional educational facilities. So education facilities to household member or the employee himself, whatever educational facility is provided by the employer, right? In something owned by the employer himself. Big corporates, they do want their employees in their own premises, and therefore there are at times in schools within the factory premises. Now those schools are where the children of the employee would study. So if it is an own school of the employer, in that case, you are going to take the cost of education of a similar institution. Well, see, providing education to children or the member of the household is the obligation of the employee. And now here what you have is a facility. Facility is provided by the employer. It is not the employer who is paying the fees. He is giving facility. If he would have paid the fees, in that case, it would fall under 17(2) IV. See, understand, there is an employee, he has got children, and what he does, this employee takes admission of the children in a particular school, right? And pays fees. The fee is reimbursed. There's a school and this employee pays fees, and this is reimbursed by the employer, to the employee. Now, this particular arrangement would fall under 17(2) IV because the school was chosen by the employee. It was the obligation of the employer to pay the fees. However, if there is an employer who provides the facility of schooling, the educational facility is provided by the employer and not the reimbursement. In that case, you have to go to Rule 3, Sub-Rule 5. Now, what the Sub-Rule 3, Sub-Rule 5 says, if the educational facility is, somewhere outside the premises in an external institute, not owned by the employee, you would know the actual expenditure. So whatever actual expenditure, let's say there is a company, there's a Tata Group company, and it has a tie-up with Delhi Public School, and any of their employee can get their children admitted in Delhi Public School. The expenses would be borne by Tata. Whatever actual expenditure is incurred by Tata, in providing education to the children of the employee in Delhi Public School, the actual expenditure would be treated as perquisite. Fair enough, very simple. However, if it is an owned institute, well, you would not have any fees. Tata would not have to pay any fees to an institute owned by itself. Like Reliance, for that matter, let's say Reliance has got its own school, and Reliance is not paying anybody anything. In that case, what happens is you have to take the cost of education in a similar institute. So you will have to take cost of education of those children in an equivalent institute, and that cost would be treated as your perquisite. This rule further says that, the education of children would be exempt up to rupees, if the value of such education is up to rupees 1,000 per child per month, per child per month. So you're not to tax, up to rupees 1,000 per child, whether it is, whether it is owned institute or it is a free, free education is provided in any other external institute. 1,000 rupees per month per child is not going to be taxed. Now here, there is no limitation as to the number of children. Like you have seen in children education allowance or hostel allowance, you can you can get a exemption of only up to 2 children. Here, there is no such limitation. You can have any number of children, and those all any number of children up to rupees 1,000 per month per child would be exempt. But what happens if this cost of education in a similar institution goes up by even 1 rupee? If it is 1,001 or 1,100, well, in that case, the entire 1,100 would be taxable. That is what it seems from the plain reading of Rule 3, Sub-Rule 5. And therefore, even the module provides for an alternative view. However, thankfully, in this case, there is a circular number 20 of 2015, which provides for relaxation. And it says that only cost of education above rupees 1,000 per month would be taxable as perquisite, right? So, but then it deals with only children of the employee. If there is any other household member, in that case, this exemption is not available. So, brother or sister of the employee studying in an educational facility, whatever is the actual expenditure or whatever is the cost of education in similar institute would be taxable, irrespective of this 1,000 rupees of exemption. Are you getting it, friends? Only children education up to rupees 1,000 per month per child is going to be exempt. Then, moving further, employer with transport business. Those employers who are engaged in transportation, like the airlines, most of the airlines, and you've got railways, you've got buses, they're big transporters. The value of benefit for the transport of passenger or goods for personal purposes. So if it is a bus fleet carrier, and they provide some personal travel to the employees or their family members, in that case, it is the fair market value of such service which is going to be treated as perquisite. However, any facility provided by employees of railways and airlines are exempt. So, railways and airlines exempted. However, other transporters not exempted. For other transporter, you got to figure out the fair market value of the service to general public and add it to the perquisite of the employees. Right? Whatever is recovered from the employee would have to be reduced. So, that goes without saying, whether it is educational facility, whether it is provision of gas, electricity, or a sweeper, or any of the helper, whatever is recovered from the employee got to be reduced. Then we have already seen 17(2) IV. It is the obligation of the employer borne by the employee, like say electricity bill of the employee paid by the employer. Well, it is perquisite. Educational expenses, watchman salary. Now, watchman employed by the employee himself. Well, in that case, it would fall under 17(2) IV. Then, perquisite of insurance premium, any life insurance premium paid by the employer on behalf of the employee, that is going to be treated as perquisite. Life insurance is your own obligation, right? Your life is your obligation. Therefore, any life insurance premium, well, that is going to be treated as perquisite. Accidental premium, right? That is what we discussed at the start. Accidental insurance or health insurance, it is distinct from life insurance. If it was accidental insurance, well, it was the obligation of the employer, right, to safeguard its employee from contingencies. And therefore, that is not treated as perquisite. However, life insurance is treated as perquisite. Then, moving further to ESOPs. Well, this is important. Do you get it, friends? Everybody? I missed out on a small point here. See, obligation of employee borne by the employer. An employee pays tax on salary. Do you agree with me? Yes, tax on salary. There would be, if you're getting taxable salary, above rupees, and your total income is above rupees 5 lakhs, you will have to pay some taxes. What happens if this tax on salary is borne by the employer? If tax is paid by the employer, in that case, such tax is also your perquisite. Let's say an employee has got 10 lakh rupees of salary, and let's say 1,20,000 rupees is the tax, assuming, it's rough calculation. 1,20,000 rupees is the amount of tax which the employee is supposed to pay. Instead of the employee paying, this 1,20,000 is paid by the employer. Now this 1,20,000 is also his perquisite, and therefore you will have to find out the salary income by grossing up. You'll have to gross up your salary. So this tax paid, discharged by the employer, which was the duty of the employee to discharge, would be treated as perquisite. However, there are times where the employer pays for tax on non-monetary items, like the benefits that we have just read. All these benefits, the tax amount arising on these perquisites are discharged by the employer. The reason why it is done is because you should get a full benefit out of it. The idea was to provide you some additional benefit, but if you are subjected to tax, where are you getting all the benefit? And therefore, in some cases, employer and employee decide that whatever in-kind benefit you're going to give me, the tax thereon, whatever it is, would be paid by the employer and not the employee. Now, this tax on non-monetary benefit, friends, is exempt under section 1010 CC. There's clause 1010 CC. 10 CC is the clause of section 10, which specifically provides for an exemption in respect of tax on such non-monetary payment paid by the employer. This is there, this exemption is there only to make it a point that you don't have to go through the entire grossing up of the salary. To keep it simple for the employee to find out his income. Otherwise, you would have to gross up the salary the way you do it while you calculate GST, backward calculation. So that grossing up need not be done, and therefore tax on non-monetary perquisite is exempt in the hands of employees, though it is the obligation of employee borne by the employer. There's a similar provision under section 40, clause V under PGBP, which denies exemption to the employer in respect of this tax, which he has paid on behalf of the employee. So whatever tax on non-monetary perquisite is paid by the employer on behalf of the employee is not allowable to him as deduction from while calculating PGBP, right? So I guess I made a point that tax on non-monetary perquisite is exempt in the hands of employee, number one, and no deduction is provided to the employer. Then okay, let's move further. ESOPs. Any questions? Okay, Bhumika. 1,000 per month per child is exempted because of this circular that I just referred to. The circular of 2015, which is a beneficial circular. Although while you read the provision, you don't get that. The interpretation is not that way. But there is a beneficial circular of the department. Once there is a beneficial circular of the department, you got to take the benefit, right? Therefore, up to 1,000 rupees, nothing would be taxed. Beyond 1,000 rupees, you got to tax it. So 1,000 is a basic exemption or a standard deduction for that matter. Now, Vaishali, just reframe your question. I did not get the question. Perquisites under ESOPs. ESOPs are nothing but employee stock option plan, or program. These are also called as sweat equity, sweat equity shares. See what happens. An employee is working with a particular employer. He gives his time, energy, he puts in all his effort. He gives his sweat. Literally, he sweats for the employer, and therefore the employer would want his participation into the business. He would want him to become owner of the business, and therefore what he does is he allots equity shares. He allots equity shares to an employee. Now these equity shares which are uh, allotted to the employee are called as sweat equity shares. Now an employee may or may not want to subscribe to the share, and therefore option is provided. Option is provided to the employee. If you want, you can, let's say, a particular employee, based on his designation, based on his work, the amount of work he has done, he could get an entitlement of 100 equity shares. He could opt for 100 equity shares, allotment of 100 equity shares, let's say. Now, this is optional for the employee. He may opt for it, he might not opt for it. And most of the employers, big employers, large employers, they do run such program wherein they want the employee to become part of it gives the sense of ownership to the employee, and therefore the employee wants the company or the employer to grow, and hence the employee stock option program. Now, if this option is not exercised, there would be no income. Absolutely. There would be no benefit. How does benefit arise on such sweat equity share? There might be a company whose shares are trading at 2,500 rupees per unit. Now they come up with a stock option plan, and they give an option to the employee to buy this one share, which is trading in the market for 2,500 for rupees 1,500. Now, do you see a benefit here? Isn't it? 2,500 market price, and my allotment price is going to be 1,500. So I'm going to straight away, earn 1,000 rupees per unit. Now, this is nothing but my benefit. This 1,000 rupees is my perquisite in a way. So the value of any specified security allotted or transferred by an employer or former employer free of cost or at a concessional rate is going to be my perquisite under ESOP, right? So it is the value of shares, let us stick to shares at the moment, value of shares, right, which is allotted by way. So allotment is important. I should allot those shares. So whenever I allot shares to an employee, either free of cost or at a concessional rate. So if 2,500 rupees worth of share is given free of cost to the employee, the entire 2,500 would become the value of perquisite. However, if I transfer it at a concessional rate, 2,500 per share is the fair market value, I transfer it for 1,500 rupees. In that case, I have only given a concession of 1,000. That concession would become value of my perquisite, provided the employer allots the share. But now, how the allotment is done? Well, first they run a program wherein the employees get entitlements. The employees get entitlements. So stock option entitlements are given based on the nature of work the employees are doing. So probably a peon would get a lesser entitlement than an officer. Fair enough. Now this entitlement is nothing but an option to buy. I might exercise it right away, or I might not exercise it right away. I'll keep the option, right? There is usually a due date to exercise the option. So until the due date, let's say 2 years is the due date, I can exercise the option anytime. So I do not exercise the option, there is no benefit. I exercise the option, but there is no allotment. I exercise the option, but there is no allotment by the employer. Again, there is no benefit. Since there is no benefit, no purpose. There is a option exercised by the employee. There is an allotment made by the employer. Now there arises benefit, right? Do you get it, friends? The benefit would have to be calculated. Now, how do you calculate the benefit? This is where, the real trouble starts. How do you compute the benefit? So I told you, okay, it was a item of listed shares and it was trading in the market for 2,500 rupees per unit. Now it was trading at 2,500 per unit. Therefore, the fair market value today would be 2,500. But then tomorrow it might change, isn't it? What if there is no trading? What if it is not traded in the stock market? How do I figure out the fair market value? And therefore, you have a rule. Rule 3, sub-rule 8 prescribes fair market value, the valuation of such equity, right? Fair market value means value determined in accordance with the method as may be prescribed. The value of ESOP or specified securities. So value of ESOP or specified securities. So it could be, not just equity, it could be debenture also, it could be preference shares also. And therefore the term security have been used. So it could be anything that is given concessional, right? It could be any security, any item of security which is given at a concessional rate. So value of ESOP would be, if the security is in the nature of equity, usually it is equity, throughout the board, usually it is equity that is given to the employee. If such equity is listed, there is listing of shares. I guess each one of you would know share markets. There is something called as the NSE, BSE, Bombay Stock Exchange, National Stock Exchange. So when it is listed on a stock exchange, and there are various other stock exchanges. So when it is listed on a stock exchange, on a recognized stock exchange, you would have the trading price, you would have the market price. Market price would always be available. Now you all are students of financial management. You've gone through financial management, I suppose, or accountancy for that matter. While you were studying financial management or accountancy, you've seen there is something called as the X right, come right price and X right price. Now this come right price is usually more and the X right price is usually less. If you just brush up your financial management concept, and the come right price would be more, whereas the price after the right issue is complete, the X right price would be lesser. Why is it lesser? Because you have more of supply. Similar is the case here. Prior to ESOPs, prior to issue of the ESOPs, the prices would be more. And after the ESOPs are allotted, the prices might go down if that is the quantum of ESOP allotment. And therefore, what they say, fair market value got to be taken as average of opening and the closing price. You got to take average of opening price on the stock exchange or the closing price on the stock exchange. Do you get it, friends? So average of opening plus closing divided by 2. This is my fair market value. Opening plus closing divided by 2 as on which date? As on the date of exercise of option, as on date of exercise of option. I already explained you how it goes. There are entitlements that come, you got an option and you exercise that option. Once you exercise the option, only then would the allotment happen. So if you exercise the option, the date on which you exercise, you got to take the opening price and the closing price and divide it by 2 so that you find out the average. And that becomes your fair market value. That would become your fair market value of the stock, right? So you come to know that the opening price was rupees 100, the closing price was rupees 80, right? And therefore, The average price is rupees 90, right? Now, this average price, let's say a particular employee exercises option for 100 shares, right? Now, this 90, getting my point, this 90 rupees would be the fair market value for the 100 shares, and therefore 9,000 rupees would be my perquisite. But if at all I am required to pay 5,000 rupees towards this allotment, in that case, my perquisite would be reduced to 4,000 rupees, right? Getting this, friends, very, very simple. The fair market value is the opening and the is the average of opening and closing price as on the date of exercise in that recognized stock exchange, since it is a listed security. What happens if a particular security is listed in multiple stock exchanges? You know, a listed security could be listed in both BSE as well as NSE. If that be the case, you got to take price from that stock exchange which has got the highest number of trades or highest volume, which has got the highest volume of trade. Right, fair enough, because you'll get more fair price wherever there are more transactions. In a market where there are more transactions, you get more fair price, and therefore it is logical to go for that stock exchange where the volume is more. Right. But then what happens if the stock was not traded on the market itself? You have exercised your option to buy the stock option, but there was no trading on the day you exercised the option, and there was no price. Since there was no price, you'll have to go into the past. You'll have to check when in the past was trading done. So you come to know that yes, 2 days ago trading was done. So whatever price you get on the earliest closing day, earliest day preceding the closest day preceding the exercise, you got to take that price. You got to take the closing price this time. You don't take average price. What you do is you take the closing price of the earliest trade that has happened on a recognized stock exchange. What if there are multiple trades that have happened on multiple stock exchanges, prior to the date of exercise? If your exercise is on Sunday, Saturday and Sunday, the stock markets are closed. Therefore, you will have to take the closing price of Friday on that stock exchange which has the highest volume, right? So closing price of that stock exchange which has got the highest volume in the past. But then the prices of the shares you could get only if the shares are listed. If it is not listed, if it is a case of an unlisted entity, so like something like a Flipkart. Now Flipkart is not listed. Amazon not listed on stock exchange. So if it is unlisted shares, right, they are companies, but they are not listed. If they are unlisted shares, you got to get it valued from somebody. You'll have to calculate the fair market value. So how do you calculate? So you have to engage a merchant banker, is what is stated. You will you the fair market value of each of the stock. Whatever is recovered got to be reduced from the value of perquisite. But then how does the merchant banker, friends, how does the merchant banker value? He would, find out the net asset value of the entity and divide it by the number of shares, and probably, come out with, add some premium to it and arrive at the fair market value. Now I am exercising the option today, in 2023, and I have the fair market value of 2018. Now, whether it would be a good parameter, the answer is no. And therefore they say that this value determined by the merchant banker should not be older than 180 days, right? So it should be something that I should have calculated recently. Only then can I find out the fair market value. So fair market value determined by the merchant banker, not to be preceding 180 days from the date of exercising of the option, right? So it is the date of exercise of the option which is important. You have to consider this date. See, the date of exercise of the option might be different from the date of allotment, right? The computation of perquisite would be based on the date of exercise of the option, but the taxability would arise only when the shares are allotted. Understand this very, very carefully. In a problem, what could be given to you is that a particular employee has exercised the option on 1/3/2023, right? He has been allotted shares on 2/4/2023. Now, which year would this particular ESOP perquisite would be taxable? Would it be taxable on exercise of the option, or would it be taxable in the year of allotment? Well, it would be taxable in the year of allotment and not exercising of the option. But then this date is equally very, very important. 30th of March 23, which is the date of exercise of the option, is very important because this is going to determine your taxability. You got to take fair market value as on 30th of March, and taxability would arise on 2nd of April, right? So 2nd of April means financial year 23-24, and not 22-23. Yes. So this is an important point to be remembered, that it is always the allotment, date of allotment, which is important from the perspective of adding it to the salary income. But then as far as what amount got to be added, we got to check the date of exercise. So date of exercise and date of allotment, both are different. Both could be different, both could be same as well. So you have exercised the option today and you have been allotted today. Well, in that case, there is no problem. Now, last part of this ESOP, deferring tax payment of ESOP of employees of eligible startup. See what happens with startups. There is a peculiar situation. They don't have money, right? They need employees. Now, how do they get employees? They would tell employees that, boss, we are a startup and we would make you owner of the business. We'll give you ESOPs. Don't expect too much of salary. And it has so happened, there have been many success stories wherein ESOPs have been given to the employees, the first employees of the company, and the startup has subsequently turned into a unicorn. The SlideShare, if you would have prepared any of the assignments, SlideShare is one such company which was taken over by LinkedIn. Now, in SlideShare, there was a peon who got some entitlements, ESOPs. He was initially employed for a small sum of 3,500 per month. And that peon, consequently, because of the takeover by LinkedIn of the SlideShare, he got that ESOPs encashed, and his total amount that he got was roughly 30 to 40 lakh rupees of amount, which that employee got, who was earning 3,500 per month, but ended up being a lakpati. And therefore, these ESOPs are important part of the startup ecosystem. In the startup ecosystem, they give ESOPs to the employees. Sometimes the ESOPs work, sometimes they don't. So there have been, stories which have not worked, and the ESOPs have turned into paper, just scrap paper. But otherwise, sometimes it also works. The employees would work for a lesser amount along with share into the equity of the company. Now, the ESOPs take considerable period of time to grow. And if I were to tax it today, if I were to tax the allotment is done, option was given to an employee, allotment is done to the employee. If I, tax it today itself, well, I defeat the entire purpose of providing ESOPs, because, it is not valuable today. It would become valuable sometime later. In order to give, solace to such individuals employed in startups, eligible startups are provided under section 80I, IBC, IBA or IBC, you will get this while you discuss chapter 6A deduction. So whatever is whenever there is a eligible startup and such eligible startup provides for ESOP, it would be taxed in the hands of the employee. The value of this particular, uh, perquisite arising on the ESOP would be taxable in the hands of the employee after 4 years. It would be taxable after 4 years from the end of the assessment year in which the ESOP were allotted. So you get a breathing time, 4 years from the end of the assessment year. So virtually it becomes 5 years. In a particular financial year, you have been allotted, you are an employee of a startup and you've been allotted ESOPs. Now, it is not taxable today in the year of allotment, but it is taxable 4 years from the end of the assessment year. So it means 5 years from the end of the financial year. So you get roughly 5 years, minimum 5 years, right? From the end of the year in which the ESOPs were allotted. Or if you actually sell the shares which were allotted as ESOPs to you, in that case, the date of actual sale, even the date of actual sale, if it precedes this 5 years, if you have actually sold it, it is the date of actual sale when the perquisite would arise. Or if you leave the startup, if the employee gets ESOP and if he leaves the startup, in that case, it would be taxed earlier. Right, so 5 years or actual sale or date of leaving of the startup, whichever is earlier, right? A, B, or C, whichever is earlier, right? So this is how the ESOP taxation would happen. However, the tax rate, it would be taxed at the rate of the applicable previous year of allotment, right? So tax rate would be the rate which have been prescribed for the previous year of allotment. See, I'll just roughly show you, we'll just go through one of the problem. So Hyperloop here, see, Hyperloop is a company, a startup. They say it issues 10,000 shares. It issues 10,000 shares, say on 31st of July. Sorry. On 31st of July 22, under ESOP, at free of cost to its employee, Ms. Komal, right? So Ms. Komal is a employee of a startup called Hyperloop, and she gets 10,000 shares, on 31st of July 22. Now, allotment of the shares is done during the financial year 22-23. So ideally, I should recover tax today itself, right? But then since it is a startup, Hyperloop is a startup, and the fair market value of the share is 100. Look at this. Fair market value share is 100 and the face value is 10. What is the benefit that I get? Fair market value 100, face value 10. I get 90 rupees of benefit. Do you agree with me? Komal would have to pay the face value. Face value, there would be no concession. Right? The benefit is 90 rupees. Now, assuming tax is at the rate of 30%, I got to figure out the tax liability of Komal. Right? She's got 10,000 shares and a benefit of 100 rupees per share. It means 9 lakh rupees of benefit has accrued to Komal due to the allotment of these ESOPs. But then these ESOPs are not, these shares are not saleable today, or I don't wish to sell it today, right? I got to hold it. And therefore, this provision rationalizes the very concept of startup. Now what happens? Therefore, the perquisite would be, look at this, in the hands of Komal, the value of perquisite as on under section 17 VI would be 9 lakh. So 9 lakh rupees of perquisite, 31.20% is the tax rate. Let's say 30% without surcharge plus health and education cess of 4%. So the total tax liability is 2,80,000. prior to this particular amendment, prior to Finance Act of 2022, it was taxed in the year of allotment itself. So it was allotted in the year financial year 22-23. Entire tax would be deducted to the tune of 2,80,000, which is nothing but 31.2% of 9 lakhs. This tax would be recovered. However, now what happens? See, look, now what happens? There are three scenarios. One, there's an employee of the startup who does not sell the shares, who does not leave the organization, and who continues working for 5 years. Komal works in Hyperloop for next 5 years, right? Income would be chargeable to tax at the rates prescribed for assessment year 23-24, because allotment was done on 31st of July 2022. The rates for AY 23-24 would be taken. However, no tax would be levied. No tax would be levied until the completion of 4 years from the end of the assessment year. Now, when did the assessment year end? Assessment year had end on 31st of March 2024 plus 4 years. Meaning what? No tax got to be recovered until 31/3/2028, right? So I'm going to tax this transaction only in the year of 28-29, financial year of 28-29. That is 1/4/2028 would it become taxable, right? However, if Komal if Komal actually sells the share out of she has been allotted 10,000 shares and she sells all the shares in the financial year 27-28. If she sells all the shares in 27-28, it would become taxable right away, right? The perquisite would become taxable in the financial year 27-28. Or if she leaves the job or loses the job, changes the job, right, on 31st of December 2025, in that case, it would become taxable in the financial year 25-26 itself. Are you getting this, friends? So this is the startup provision wherein they say that you've got to tax it after 4 years from the end of the assessment year in which the ESOPs were allotted to the employees of eligible startup, or the date of actual sale by the startup employee, or the date of leaving of the startup by the employee, whichever is earlier. So this is the provision relating to startups and the ESOPs in total. Do you get this, friends, everybody? Well, you just go through the provisions, reading the module, going through the module is very, very helpful. You have to, these are very simple to understand, but difficult to retain. Most of the times, you don't retain the exact provision because there are so many components, there are so many small provisions, and therefore it is very simple to forget the valuation aspect of perquisites. And therefore, the only option is you got to read it again and again. The more you read, the better you'll retain. The better you'll retain, the better you'll solve the problem. But overall, it is simple. You will have to just go through the provision. I've tried to, take up examples. I've tried to give you small MCQ to make you understand the provision. Just going through the module once would help you a lot as far as clarifying your concepts further and making you remember the provision. I hope you have understood this, friends. Tomorrow we continue with part of the perquisite and we also take up relief under section 89(1). I'll deal with some practical aspects and we'll also take up a few problems on perquisites. For now, I'm logging off. If you've got any query, you leave it in the box. I'll be glad to answer your queries. Thank you so much, friends. Thank you so much for your patience. Let's continue the day after, 21st. 21st would be the last lecture on salary. So salary would be deemed to be completed on 21st. Right. Thank you so much.